Good to be here. Thanks for joining. That was a great panel. When I was asked to speak here today, I looked at the panel list and some of the other speakers, and I thought, I'm not going to educate anyone here about blockchain today. So what I am going to do is talk about supply chain finance and where it intersects with blockchain. I think you've got enough blockchain experts in the room. By way of background, like Eric, I was a corporate venture capitalist at both Citibank and First Data, same as Eric, weird coincidence. And one of the things I did early in my career was I attempted to modernize trade finance using public key infrastructure. For anybody who knows public key infrastructure, super painful, super expensive, super heavy lifting. We ended up calling it PKI instead of public key infrastructure, pilots keep increasing, because we never got it out of the lab, right? It was too difficult. I'm hoping with blockchain, we're on a different path. So real quick, what is supply chain finance? It's a finance tool used by corporations and banks, delivered by banks, whoops. So security is very important, but just not right now. So if someone who has, I guess that would be me. So McAfee, I will update that later. So supply chain finance is a set of tools delivered by banks, used by corporations to improve their supply chain finance, exactly as it sounds. Working capital, better terms, better conditions when you buy goods and services, and it goes through the accounts payable, accounts receivable. My first job out of college was actually managing finance for a small company. So I got to see up close and personal the importance of discounts, what used to be called 210 net 30, now thanks to some others, there's dynamic discounting. This chart is available from AITE Group, AITE. They do some great research on supply chain finance. Okay. Technical. Oh, did it go? Thanks. A little delayed. Thanks. So supply chain finance, and this is slightly dated, but the point is traditional trade finance, for those of you that have heard of letters of credit, that type of traditional trade finance, very document-centric, very heavy lifting, very difficult. That's declined rapidly, and the fees associated with it have declined as well. And it's moved to something called open account. That is whereby you just trust the other party to pay their bills. Great. Well, not great if you're a bank because you're not involved in that transaction. Might not be great if you're the seller because you might not get paid. Might not be great if you're the buyer. I have a friend who's a buyer for a large German auto parts manufacturer, and they often place double orders just to make sure they get the supplies. So as much as we think of supply chain being healthy and things move, there's a lot of flaws in today's supply chain systems. The actual physical movement of goods, if you will. There we go. So if you look at the economics of supply chain finance, it's really about what it says in this box. It's about optimizing time value of money and goods for both the buyer and the seller. And the reason that's important is a lot of the tools are geared towards either the buyer or the seller. What you're really trying to do is, and I apologize, it's a little blurry, but you're really trying to balance where the buyer and the seller cost of goods, assurance of delivery, health of the supply chain is balanced between the two parties. Now, in this case, this is a chart from Citibank. They offer this service as part of their supply chain finance offering. But it's that balance that you're really trying to achieve. Now, most of us are from a fintech, bank, financial services background. One of the things we often forget is the other side. And this is where I believe blockchain and supply chain finance is going to come first, and that's from the corporates. So the corporates have a group called Treasury. They report up to the CFO. Their job is to manage balances, to manage cash flow, to manage investments. Well, if you don't manage cash flow, you don't have money for investments. So there's really this balancing act going on, risk management, liquidity management, and so on, to make sure that the corporate treasurer is using the bank relationships effectively to meet all their short-term obligations and yet not have large amounts of cash sitting around not working. So when you look at a supply chain finance chain, so to speak, third-party capital providers, trade and treasury banks, dominated by some large ones that are global like Citibank, HSBC, Standard Chartered, et cetera. You have sellers and buyers that are corporates. You have commodities, tier 2, tier 3 suppliers, which, by the way, the tier 2, 3, you could go, I wouldn't say ad nauseum, but you can go quite a ways down. And then you have flow of goods and working capital. Now, a lot of people say, well, is this where blockchain comes in? Well, actually, yes and no. So there's already a set of parties that do this, and oh, there we go. There are companies like Kinaxis, JDA, Ambro, GT, Jamaica, Kariba. And what they've all done is they've looked at the working capital opportunities. They tie into SAP systems and some others. They look at treasury systems like CGI Twin, Temenos, legacy systems like Mises, SureComp, and they try to make sure that the corporates and the banks are able to work together, communicate, exchange data. There's something called EDI that's been around since the late 70s, which allows these organizations to exchange data. Obviously not super efficient, or we wouldn't be having this conversation. So when you look at McKinsey, who I am a big fan of their research, even though I work for CapGemini, they say trade finance is one of the top use cases or applications of blockchain. I tend to agree with that. And I think the reason is because there's a concept that I'll just cover real quickly here, which is a smart contract. And that is the application of a blockchain underneath, but it's the automation of transactions using predefined contract, negotiated terms, trigger events like timing, delivery, others, execution, settlement, and then the physical and digital record keeping. And the reason this is important is because you can now envision a system whereby you're able to see goods move, payment move, all without human intervention because the systems can automate it. There's somebody speaking later from a company called SkuChain that I was involved with. And one of the things we did over the summer was a system whereby there was an IoT sensor in a bale of cotton, went from Australia to China, that sent a signal. It said 20 bales have arrived, the humidity level's below 10%, they meet all requirements of quality and condition, send a signal to the cloud, release payment. Now the reason that's important, as supply chains grow and grow and grow in complexity and distance, you're now able to envision a system where you don't need an inspector at the port to wait for the large ship to offload, right? So there's a lot of automation and efficiency that can come about from smart contracts. Now there are people working in the blockchain startup landscape, which is diverse and large. There are those that are covering supply chain, Filament, Hydro, SkuChain I mentioned, and others. And basically, it's complex, and there's a lot of moving parts, and the question becomes, can one startup deliver enough value to get multiple parties onto the system? Or do you just have to fix one part of the supply chain? And that's really the question at hand, is can you fix part of the supply chain? And so recently, we were able to work on a bid from Holland, Europe, let's say, because there were multiple banks involved, and it was for digital trade chain. And digital trade chain was thought of by some of the top trade banks in the world, HSBC, SocGen, Rabo, Natixis, and it was led by a small bank called KBC. And basically what they're trying to do is the letter of credit automated for these banks on Hyperledger or R3. And the reason this was really important is it was a multi-million-dollar opportunity, put out an RFP, and everyone had to reply to the RFP, and they were going to use smart contracts, and the bank consortium had designed all of this. So this was a very well-thought-out commercial activity. Now, interestingly enough, the contract has not been issued yet, but if you look up digital trade chain on the web, you will find quite a bit of information about this particular opportunity, looking to make the blockchain real in cross-border trade. Now, I mentioned earlier, I think corporates are going to drive a lot of activity. Just recently, a blockchain platform for supply chain finance came from China through Foxconn. Foxconn has 30,000 suppliers that they need to onboard, pay, track the health of their supply chain, be able to get financing down that supply chain from tier 1, 2, 3, 4, et al. And then Alibaba joined forces with Lending Club to kind of do a similar thing just a couple of years ago. Haven't seen a lot of that in market, but I think this is what we're going to see. Very large, healthy corporates working with supply chains to deliver supply chain finance rather than relying on the banks to deliver supply chain finance or waiting for them to be on the blockchain. And the reason this is important for the blockchain allows these parties to be in a trusted, anonymous environment. And that's really key. So, in summary, the reason I'm excited about supply chain finance and blockchain. Blockchain attributes, and you can debate a couple of these, but I think you'd have to concede some of these are absolutely valid. Disintermediation, trustless exchange, high quality data, durability, reliability, longevity, process integrity, transparency, and immutability. That's personally I think one of the keys. Ecosystem simplification. Onboarding suppliers is one of the key difficulties in supply chain systems, and lower transaction costs. So what does supply chain finance require? Well, it's a complex ecosystem, so you kind of need a single source of truth, some way to look at a system and say, that's absolutely valid for all parties involved. Disparate data formats and sources, I mentioned EDI earlier. Ask anyone who runs a supply chain finance organization, they're not gonna love EDI. Uncertain data quality and timing, there's a lack of asset quality and assurance, and there's too many parties to engage easily. There is a concept in supply chain finance called KYCC, Know Your Customer's Customer. And I'll finish with this story, which is a German bank I was talking to had financed trucks moving from Europe to the Middle East, and no problem, they're trucks, they were pickup trucks, no big deal. Someone on the ship had loaded gun turrets onto the trucks, so when they arrived, they were now illegal goods, and the bank was responsible. So when you say KYC, you actually have to understand the end result of the shipment. You have to understand throughout that supply chain where the goods started, where they end up. The other benefit of a blockchain is you get something called provenance. You can tell through the chain where the goods originated, where they ended up, who was responsible, who touched, who interacted with the transaction in any way. So that concludes my overview on supply chain finance with blockchain.